Good morning, everybody. I make it around about 11:30, or certainly near enough to 11:30 to do the initial introductions. Welcome to this morning's webinar. I am going to be talking about a specific type of all-employee share plan this morning, the share incentive plan. The webinar should last for around about half an hour, and there'll be an opportunity to send questions later. Just a bit of information about me. My name is Sarah Anderson. I am a share plan solicitor at RM2. I've been working with share schemes for around about 20 years now, working largely in private companies. And that's the kind of business that this seminar is aimed at this morning. So this morning's webinar is intended really to be a practical outline introduction to the share incentive plan. It's not supposed to be technical, it's just supposed to be explaining about the key benefits of the plan, the key requirements you need to make it work, and some practical ideas about setting it up and administering it, and generally how it works in real life. And I will also be using a quick case study from one of our clients who used a share incentive plan to very positive effect. Seem to be struggling with my page down this morning. Here we are. So what is a share incentive plan to begin with? Well, it's share incentive plan is commonly known as a SIP. It's been around since 2000, so it's pretty well established. It's government recognised, what used to be called an approved plan. It's now known as a tax advantage plan, which is a really good name for this particular type of scheme, because if you use it correctly, you can pretty much end up with zero tax rates. No income tax, no national insurance contributions, no capital gains tax. In order to get those tax benefits, obviously there are certain hoops to be jumped through, and the key thing is that this plan must be made available to all employees. I'll talk about that a little bit more later. The scheme involves actual shares held in a trust rather than share options. It is very flexible. However, there are sort of those rules do apply, but despite that, it's reasonably flexible in the way it works, because it allows you to award shares to your employees in various different ways, including actually giving free shares away, allowing shares to be bought by employees, or allowing them to do a bog-off arrangement, actually a buy one, get two free. So for every share that you buy, you can be given two further free shares if you want to do that. The plan is intended to encourage long-term motivation and employee reward. The legislation actually states that it is intended to provide employees with a continuing stake in the company. So if that is your intention, then I would say SIP is the go-to plan. I'm going to talk a little bit about the key benefits, and while it is true that you should never implement a share plan just for the tax advantages, it is undeniable that the share incentive plan is absurdly tax efficient. So if you give a share to an employee under the SIP, or if they buy shares, they buy the shares out of pre-tax salary, and there is no income tax or national insurance contributions on the gift of the shares. Typically that's not permitted. When you give employees a share in your company, they'll usually be taxed on the benefit, but not under the share incentive plan. And when the shares are sold by the employee, assuming certain rules are followed, there shouldn't be any capital gains tax for them to pay either. So from the company's perspective, obviously no NICs to pay includes employers' NICs as well as employees' NICs. So there's a saving for the company as well, which can be significant. And there is also corporation tax relief available for the company, deductions for the cost of setting up and running the plan. There are also capital gains tax reliefs in certain circumstances for founders selling their shares into the SIP. Again, certain rules apply, but that's an additional tax benefit relating to this scheme. Leaving aside the tax benefits, I also wanted to talk a little bit about the flexibility of the plan. As I've mentioned, participants in a SIP can acquire their shares in a variety of ways. They can receive free shares, just simply a gift of shares of up to £3,600 worth of shares each year, which, as I say, is income tax and NICs free. They can buy up to £1,800 worth of shares each year out of pre-tax salary. And for each partnership share that they buy, they can receive up to 2 further free shares, known as matching shares. That's the bog-off arrangement. So up to 2 free further shares for every partnership share they purchase. So that adds up to a maximum allowance of shares with a value of up to £9,000 per participant each year. So that's a reasonable amount of money, particularly if you're looking at an all employee share plan. Some companies, some larger companies, wouldn't necessarily reach that value of shares. That depends very much what the market value of the shares is at the time, but it's fairly generous when you think of it from the perspective of an all employee plan. Certainly the most generous that's available anyway. I also wanted to talk about, and this is because of the concept of SIPs operating in private companies, is that a big advantage of SIP is that even though it's an all-employee plan, it doesn't mean that owners of a private company are having to give up control of their business. So to begin with, you can actually use non-voting shares in the plan, which obviously kind of removes that concern about control almost entirely. In addition, any awards that are made under the SIP will only be made in accordance with the company's wishes. So there's always control over the number of shares that can be acquired by the employees. And you might want to do, for example, that by just a one-off award. You want to give everybody a lump of shares today for your existing employees, no further awards made. You know exactly how many are going to be given out. You can limit the number of shares at that award or at future awards. If employees haven't paid for their shares, so in the case of free shares and matching shares, they can be forfeited when they leave. And if people cease employment, they can be required to sell their shares back at any time. So in brief, you've got control over how many shares you give out, when you give out the shares, and you can get shares back from leavers and recycle those for future awards if you wish to do so. So in terms of a private company owner who's a little bit concerned about whether the employees are going to affect a huge takeover of the company by way of their SIP shares, totally in your control, not going to happen. So those are the benefits. What are the key requirements? Well, the main ones are, first of all, you need a trust, and you need trustees to run that trust. A SIP trust has to be UK based, so it can't be based offshore. It has to hold shares on behalf of all of the employees, so it's not discretionary like any other employee benefit trust you might have come across, and it needs to operate within the SIP legislation. The main point for the SIP trustees is they must always act in the best interests of the beneficiaries, which is the employees themselves. And so for that reason, it's quite common to have an independent professional trustee running the trust, especially for larger companies. Although you can, smaller businesses quite often will have independent trustees like directors of the company who are acting as trustees. You just need to make sure in that case that if you're a director of the company and you're a trustee of the SIP, you are wearing different hats when you make decisions as a SIP trustee. And one of the advantages of having a SIP trust in place is it's quite a good way of ring fencing a certain proportion of shares for employees. So if you decided you want to give away 10% of your company to the employees, you can make sure that 10% is kind of stuck in the trust or given out to employees, but you're not going to go over a certain amount. You can use the trust to recycle leavers' shares, which is, in a way easier than going through the rigmarole of issuing new shares and then buying them back from leavers each time and cancelling them. And you can use it to create an internal market for employees in a private company. And I'm going to have a look at an example of that later on with a case study. The key thing there is, for as long as the shares stay in the trust and held there for employees, any gains will be entirely free of capital gains tax. So actually for employees, there's very little advantage in removing the shares from the trust, as that removes that tax shelter for them. The other main rule relating to the SIPs is that they have to be offered to all employees in the company, because the main purpose behind the plan is set out in the legislation. It must be set up to provide employees with a continuing stake in the company. And very importantly, the main purpose of setting up your SIP must not be for the avoidance of tax, albeit that a SIP does provide very, very good tax benefits, but that mustn't be your main reason for setting it up. You have to make it available to all employees, but you can include some but not all subsidiary companies if you want to do that. So for example, if you've got overseas subsidiaries, you may not wish to extend the plan to the employees in those subsidiaries because the tax advantages won't be there. So there's very little point in including those employees in the SIP plan. Crucially, employees must participate on the same terms. So that doesn't necessarily mean you have to give everybody exactly the same number of shares, but you do need to make sure that you don't end up, for example, with higher paid employees or directors inadvertently or otherwise being the main beneficiaries. You can vary the number of free shares on the basis of salary or hours worked or length of service. In terms of the partnership shares, of course, in terms of same terms, there's a financial limit on the amount of shares or the value of shares that can be bought anyway. So that kind of makes it quite difficult for higher paid employees to benefit disproportionately from a partnership share award. But you know, if you were going to make an award of free shares based on the basis of salary, for example, you wouldn't be able to say, I'm only going to give free shares to people earning more than £50,000 a year. That wouldn't meet the requirements of same terms. You need to think about it, make sure that you're providing a measurement that's reasonable and proportionate depending on how much your employees earn in your business. Do note that you can set a qualifying period of employment for up to 12 months before you have to invite employees. You don't need to include new joiners if you don't want to. You need to make sure they've passed any probation period before they get to be invited in the scheme. And do note that majority shareholders can also participate, provided that they're employees. In fact, if they are employees, they must be invited to join the plan, otherwise it will be breaking the SIP legislation. And then the final requirement for the SIP is that it is a long-term plan. And that means that you can suffer a clawback of tax benefits if the shares are held in trust for less than 5 years. So, for example, if you are given free shares, there's no income tax or national insurance contributions on that award. But if you take shares out of trust within 3 years, there will be a charge to tax and NICs. That's based on the market value of the shares at time, the market value of the shares at the date they're taken out of the trust. If you hold them for a bit longer, between 3 and 5 years, that charge reduces, and it's based on the market value of the shares at the date of award or the date taken out of the trust, whichever is the lower. So the tax charge reduces over time. And by the time you hit the 5-year period, there won't be any clawback at all. There are some exceptions. So if an employee leaves within those periods and they're a good leaver within the terms of the legislation, or if the company's sold or taken over for cash consideration, again, there will be no clawback in those circumstances. But the key thing is to make sure that you keep your shares in the trust for 5 years or more. And at that point, you've got no clawback of income tax, no clawback of national insurance, and all that gain over 5 years, as I say, will be free of capital gains tax. Key point is don't take your shares out of the SIP unless you absolutely have to. So let's talk about setting the plan up. Here are things that you will need and some things that might be helpful. So very important thing for the SIP is some kind of design blueprint. So you need to think about how much you're going to be giving away to people, maybe your 10% pool, what type of shares you're going to be using, and that might be, that's kind of has two meanings really. It's like, are you just going to be using ordinary shares in the company with full voting and dividend rights, or do you want to set up a different class of shares for employees which maybe don't carry voting rights, which you can do for a SIP? And the other question is, are you going to be giving your shares away free, or do you want people to pay something for them? And if you're going to ask them to pay something for shares, partnership shares, are you going to provide a match? It goes without saying that you will get a better take up the less employees have to pay. So if you do want to pay something, it's very often a good idea to provide a match as well, whether that's a match of 1, 2, or some kind of fraction between those. It can really help the take up, especially if you're doing a first year's award, get people's interest built up there. To make the plan work, you will need a set of plan rules and a trust deed. You will need a trustee as well, obviously, for your trust. You need a bank account for the trust so that it can take deductions from salary to acquire shares on behalf of employees. You'll need various approvals from shareholders, board resolutions. The directors will usually need to approve a plan. You, excuse me, if you've got particular shareholder consents required, you'll need to take that into account as well. Alongside the rules and the trust deed, there are also agreements for the employees, which is what you use for them to actually enter into the plan. So you have a free share agreement if you're giving free shares, and you have a separate partnership share agreement if people are going to be buying shares. And the partnership share agreement will also include, for example, any match that you're going to put in place. So individual employees have to sign up to a partnership and free share agreement in order to be involved in this scheme. Good idea to have some employee communications documents or frequently asked questions or something along those lines, because a SIP can be reasonably complicated, and because you're involving really indirect share ownership, it can be a little bit more complex than understanding an option. You know, some employees don't really have any idea about share ownership. Why would they? You need to kind of explain it to them what you're giving to them. And also, if you're giving away shares that are free, make it clear that this is a real benefit to them. Sometimes people look a gift horse in the mouth, so I think that's where your communications program can really come into play. Explain what a benefit to them the SIP is in terms of the shares that are being awarded and the tax benefits accruing to them. You will need, if you're a private company, to agree a share valuation with the Inland Revenue before you make any awards of shares. And as an administrator of share plans, we find that a well-organised payroll is probably a must-have rather than a benefit and a kind of nice to have. You might benefit from some amendments to your Articles of Association, especially if, for example, you're going to be talking about using a different class of shares. You might want some detailed equity modelling. If you've got large numbers of employees, a lot of leavers, people coming and going, have a rough idea of how many shares you are going to be giving away each year, and what percentage of shares might be recycled through leavers, and that will kind of give you an idea of how your scheme is going to work over the next 5 years in terms of numbers. I've mentioned the independent administrator and trustee before. There can be a real advantage of having an independent person running your SIP trust, or even if you don't have a full independent trustee, you have 2 people in the company and then maybe an independent one sitting alongside them, especially if you've got a trustee who knows or has at least some understanding of how the SIP legislation works. Because, for example, you know, if the directors decide they want to make a free share award, but they are doing it out with the rules of the legislation, it's good to have a trustee there or some advisor who can say, actually, you can't do that, don't do that, you can't just give it to some employees, your measurements for salaries are inappropriate and disproportionate. It's good to have somebody on board who understands how the legislation actually works to make sure you don't trip up over any of it. And you might also want a really detailed employee common strategy, which is tailored to your workforce. So, you know, it's quite one thing to be, in my world, we all sit in a little office and there's not very many of us, and you can have kind of meetings and we're all mainly office based. If you've got factories or people on the road, it's a totally different ballgame. So you need to think about how you're going to be communicating that plan according to your employees' particular needs. I'm just going to have a quick look at how it works in practice, a really quick kind of step through as to what happens. So you've got your company, you've got your employees, you've got your founder and your seller. So the first thing is your company sets up the SIP trust, step 1. The company invites the employees to participate with sending out the free share and partnership share agreements. Hopefully the employees accept those, including any salary deductions if they're going to be buying partnership shares. The company issues the shares to the trust, because the trust has to get its shares from somewhere, or alternatively the founder can sell the shares to the trust, if that's the way you're going to be setting up your arrangement. And then the trust just sits and holds the shares on behalf of all those employees in the corner. In the meantime, if dividends are paid, trust pays the dividends out to the employees or arranges for the dividends to be paid out by the company, and then if people leave, the trust can buy shares back from leavers and recycle them for future awards. So that's a kind of quick step plan of how the scheme would work on a sort of daily basis or a monthly or yearly basis. Once you've made the first award, there's some ongoing work to be done administratively. You need to register the plan with the Inland Revenue on the online employment related security system. You need to send in an annual return each year. Very important that you keep records of all the awards made, and especially the leavers and the reasons for people leaving, because whether somebody is a good leaver, for example, somebody who retires or dies, that will make them a good leaver for tax purposes under the SIP legislation. If they just resign, that won't be a good leaver reason. So you need to be very clear about why people have left the company when you're handling a SIP plan. Obviously keep records of all correspondence with HMRC, that goes without saying, especially the valuation agreement is very important. And the company will need to liaise with the trustee, because it's the trustee that makes the awards and kind of does all the paperwork for the plan. The company needs to let them know what awards they want to make. The trustee makes them. And there may be funding requirements for the trustee as well. The trustee itself needs to submit a trust return each year. As I said, trustees must act in the best interests of the beneficiaries, and they need to generally act in accordance with the trust's powers and duties. So one key thing, for example, is that the trust itself must not pay when it's buying shares back from leavers. It mustn't pay more than the market value for the shares, whatever that is at the time. So a few ongoing bits and pieces to be held on to. Now, there's just one tip. It's like on the online ERS system, it's not a perfect system, HMRC's online system. We tend to take screenshots of pretty much everything because it's not always 100% efficient. So that's my tip for the day. I wanted just to quickly run through a case study. This is a client of ours, not the real name, obviously, that set up a SIP actually and ran it alongside some other share schemes as well. I'm going to call them the Heron family. The Heron family and Heron Limited, whatever. It's a fine little company, been going for years. There were no particular plans to sell it, but Mr. Heron was getting on a bit and needed to think about succession. And he also wanted to strengthen a sense of commitment and loyalty across the whole workforce, and to deliver something that would provide a clear economic benefit for top participants. So not just the kind of, if we ever sell, you'll make some money, because that may or may not ever happen. Employees have no control over that. But actually a regular dividend payment or the ability to sell shares is going to provide some cash in pocket, potentially every year. Very much focused on the long term. No hurry here about I need an exit in 3 years. But of course wanted to maintain a majority interest for the Herons and all the little Herons. So it's quite long. This is quite a long while ago, but the scheme ran for a long time. So they set up a share incentive plan and a SIP trust, and they gave everybody free shares. They used a points-based system, so they worked out a mixture of length of service and salary band to make sure that nobody was being disproportionately rewarded. When people left, the SIP trust bought the shares back and recycled them. And employees were also allowed to sell the shares back to the SIP, provided that the SIP had the funds to do so, and that there was a way out for the shares again through a future award. So there was a kind of internal marketplace going on there. So what they did was, we have Mr. Heron, who was the majority owner. He sold shares into the SIP. The SIP bought shares, increasing its interest, and Mr. Heron reducing his. And the employees were awarded free shares and were able to sell them back to the company over the time period. And those shares were recycled on an ongoing basis. So they actually did free share awards every year. They didn't have many employees. I mean, there was about 45 of them, so it's not, not the biggest SIP in the world. We agreed valuations for their SIP every year because of the ongoing marketplace. And if people left, their SIP shares were bought back at the latest agreed market value. They also had an EMI option scheme in place, and they had an EBT, which was a discretionary scheme, not a discretionary trust, not like the SIP. So where people's people had exercised EMI options and acquired shares, they would typically be bought back by the EBT rather than the SIP, because you needed to make sure that the SIP shares were held for all employees, whereas the EBT was used on a discretionary basis. And everybody got dividends every year, which was where the economic benefit came into people. So you had a double whammy for employees with SIP shares. You got a regular dividend, which was nice, and if you decided you needed that conservatory and there was a market for the shares, a SIP could buy them, you could sell your shares and do your conservatory or go on holiday or whatever it is what you wanted to do, and it worked very nicely. It went on for a number of years. But you know, sometimes there's a man at the door with a check that's too big to turn around. So in 2017, that man with a check duly arrived and the company was sold. And as a consequence of the shareholding, this is what the shareholding looked at the end. So Mr. Heron still held a big chunk, and so did the Heron children. But by this time, the employees, by way of the EMI and the SIP, had built their interest up to about 19%. And they did quite nicely out of the sale, thank you very much, as did everybody else. And Mr. Heron was happy to share that 20% with his employees because they'd helped him get there over the years. So the outcome, as I say, the Herons retained the majority interest. The SIP shareholders didn't pay any capital gains tax because all the shares were in the SIP, held on for 5 years or more. And those shares that hadn't been held for 5 years, because it was a cash-based exit, no CGT applied anyway. The EMI option holders and or direct shareholders got their entrepreneurs relief, as it was at the time. But the key thing was Mr. Heron had managed to transfer a significant part of his shareholding over a period of years, which is what he'd wanted to do. He had fantastic staff retention rates. People were there for years and years and years and years. And he reckons, who knows if this is true, but what he felt was because it was very much down to the economic benefit to the staff, which was delivered by the internal share market, the dividend payments, and of course, just the general impact on the company culture and the concept of reward, which was which existed anyway, but was made so much better by the existence of the SIP and the fact that everybody felt that they were an owner in a company. No, they didn't feel like they were an owner in a company. They were owners in the company, and that made a huge difference. And the owner really felt that his vision had been achieved. And for us, RM2, Herons were a very long-standing client of ours. We had been operating their SIP for years. And the overall impact, of course, once a company is sold like that is the end of your client relationship, which is always very sad. But the fact is that we helped create that sense of employee ownership. We achieved the company's vision. We got the owner to where he wanted to be. And it's worth losing a client if you can make the client happy in that way and make the employees rewarded and happy in that way as well. So that's a quick, I'm almost at 12 o'clock. So that's, I think this is a one-off. I must have talked quickly. I very rarely manage to get this seminar done in half an hour. But just as a quick kind of, 3 things to take away. If you want to deliver all employee ownership with actual share ownership, albeit indirectly via the trust, but on a very long-term basis and in a way that feels fair and equitable for everybody in your company, and if you want to do that tax efficiently and pretty flexibly, SIP is really the go-to scheme. SIP's my favourite scheme. It makes me very happy. That's technically the end of the webinar, but I will just check that there are any questions, and there are. Now, I'm going to just say at this point, the questions bar on this GoToWebinar is really tiny, and I really struggle to read it somewhere, and it may just be me being really stupid because I can't work it, but I'll do my best. So I've got a question. Do SIPs require dividends to be paid when founders are paid dividends as a tax efficient method of regular income? That will depend on the class of shares that you use. If you are using one class of shares and the founders have got ordinary shares and the SIP shareholders have got ordinary shares as well, then yes, you will need to pay dividends in the usual way. If you have 2 different classes of shares, then you can pay dividends on a different basis. So that's the answer to that question. Are there any disadvantages to SIPs? Yes, they're complicated. They involve shares rather than options. They're more expensive, I think, than your usual. I mean, if you're doing a very bog standard, for example, a very bog standard EMI scheme with options exercisable only on an exit, the setup costs and the ongoing administration costs are obviously going to be less. However, the tax benefits even of EMI are not as good as a share incentive plan. And obviously an EMI is a discretionary scheme. I think a SIP is probably the only one that gives you that real sense of we're all in this together. So that'd be my answer. The main disadvantages are the fact that it's complex and it has to last a long time. It's a bit like a dog is for life, not just for Christmas. Very little point in putting up a SIP if you're going to be closing it down in 3 years' time. Okay. Oh, I hate this thing. It's so difficult. Okay, so are there any disadvantages? How does a SIP differ from an employee ownership trust? An employee ownership trust is a trust. It is a trust that holds shares on behalf of all employees. That is true. However, an EOT is usually set up to buy shares from selling shareholders in a tax efficient manner, to buy the majority of shares in a company from the sellers, so that the company is then totally under the, not totally, it is, well, no, it's under the control of the trust, which acquires a majority interest in the shares. That gives the sellers capital gains tax relief. It creates a company that is genuinely employee owned, but the shares, once in the EOT, really just sit there. They are held on behalf of everybody as a kind of clump of shares. A SIP holds shares on behalf of all of the employees, but it will hold 10 shares on behalf of Bob and 25 shares on behalf of Sue and 17 shares on behalf of Rita, depending on how people have been awarded their shares. And those shares can move around, as the case study demonstrated. An EOT is really just holding a majority pot of shares. You can run a SIP alongside an EOT if you want to. If you've got an EOT that holds 51% of the shares in the company, you can use the remaining 49% of the equity for employees to acquire shares directly or by way of options. That is possible, but a kind of EOT is it just sits there and is the controller of the company. Is it possible to use growth shares as part of a SIP scheme, and is it possible to get HMRC clearance for the share value? I have never used growth shares in a SIP. I don't know if that would work. I'm sure you could get clearance of the share value, but I'm not quite sure how that would necessarily work in terms of the SIP legislation. So that's a question I've not been asked and I don't know the answer to. I'm sorry. In your case study, you mentioned 6 monthly valuations. Is that a requirement? No, it's not. The Heron company did 6-month valuations because they had a very active marketplace. You'd usually only get a share valuation agreed for a SIP before you made the award, which might be once a year. A SIP valuation with HMRC will last for 6 months anyway. The only thing with doing it yearly is if you have, say you get your value agreed in January, it runs out in June and you have a leaver in August, you're usually going to have to wait for those leaver shares until the next award, which is usually fine. That's normally how our clients do it. Or you need to make sure the valuation is updated. So you don't need to. Sometimes it can be more convenient. How are SME shares values typically calculated? The company's value. We will usually use, well, there are lots of ways of valuing private company shares, of course. Our go-to approach for HMRC is to use a multiple applied to post-tax profits. But of course, if you have a recent transaction in the company shares, HMRC will often rely on that. Once you have a SIP set up and you are doing regular valuations, it ends up typically kind of rolling over and you use the same consistent valuation over years to make sure you don't have a lot of lumpiness going on. But typically HMRC are very happy for private companies to accept a multiple applied to post-tax profits. How does a SIP get around the Companies Act for a company not buying its own shares? The SIP trust is separate from the company, so the company isn't buying its own shares. And even if I think I know the bit of the legislation you're referring to, which is there is an exemption for a tax advantage scheme like a SIP anyway, so there's not a problem with that. I don't think there are any other questions. Okay, I'm just checking I've not missed any. Needless to say, if I have missed any questions, or if something occurs to you after this webinar, you've got my, I shall go back up to the top. You've got my details at the top, which are here. sarah.anderson@rm2.co.uk. I am very happy to receive emails about well, share schemes generally, SIPs in particular. Just drop me an email if you've got a particular question, or if you phone that number, somebody will get a message to me. Our office is kind of semi-closed, semi-open at the moment, but I will call you back if a message gets to me. So I'm very happy to answer any questions. I think we are now at 12:05. So all remains for me to say is to say thank you very much for listening. I hope you found it interesting. We will be doing more webinars on other employee share schemes on a regular basis. So possibly I will speak to you again in the future. In the meantime, thank you for listening, and I hope you all have a good morning.